Let's get started with what was the story of the day and continues to be the story of the day, the 800 billion rand stimulus package that was announced by Finance Minister Tito Mboweni a little earlier. This is a combination of interventions from National Treasury as well as the Reserve Bank, and this is all in the efforts to boost the economy from the economic carnage from the coronavirus lockdowns and also the recession that it was already in before the lockdown began. But joining me to unpack this, a panel of economists, esteemed economists in South Africa. We begin with Arthur Camp, Chief Economist at Sanlam Investments, also joined by Annabelle Bishop, Chief Economist at Investec. And for a view on exactly what will happen in our restaurants industry, we're joined by Wendy Alberts from the Restaurants Association of South Africa. Thank you to all for your time on this Friday afternoon. Let us begin with just hearing from the Finance Minister, Tito Mboweni, a little earlier when he did announce the details of the funding mechanism for COVID-19 and stimulating the economy. It was an 800 billion rand deal that he did announce for South Africa. Let's hear what he had to say.
Our combined fiscal and monetary policy package is well over 800 billion rand. This is a major fiscal and monetary policy response, extraordinary. The main components of the fiscal response can be thought of in 5 components, namely, firstly, an extraordinary health budget to respond to the virus, 20 billion rand. Secondly, the relief of hunger and social distress. Thirdly, support for companies and workers. Fourthly, the phased-in reopening of the economy, which the President spoke about last night, April 23rd, 2020. And finally, the supportive monetary, banking, and financial market measures.
Arthur, allow me to begin with you as the man amongst the ladies in this conversation right now. Early on this week, we heard from the President around a 500 billion rand stimulus package. Today, the Finance Minister unveiling an 800 billion rand stimulus package. Add up the maths for us. Exactly what is this 800 billion rand consisting of?
Fifi, good evening. So it's obviously the full range of measures that was announced the other evening. Plus also, I would assume the Minister is referring to the reduction in capital requirements. Obviously trying to get lending going and changing regulations on lending to make it easier for banks to lend. So if you pack up this whole package, it was interesting in the sense that there isn't much fiscal space, but I think that the government has done particularly well in addressing the issues at hand. And particularly also by using these extraordinary measures. It's not just the easing of the bank regulations, but it's of course also the other measures. There was the 200 billion rand guaranteed lending facility. That should hopefully also lower borrowing costs and also facilitate lending. And then also the loans themselves, the banks themselves giving loan repayment holidays. And then of course also on the side of the fiscus itself, the tax relief measures. Most of those are the deferrals. There's about 44 billion rand of deferrals and 26 billion rand of actual relief, but nonetheless still significant. And then over and above that, of course, we also had the reprioritization of spending, and that's obviously targeted at particular relief for social grants recipients, but also wider than that. And then also, of course, the job protection and creation measures of 100 billion rand announced. Not particularly clear on that. It might be from UIF funding. So if you add this all together, it was the 130 billion rand of reprioritization of spending, the 100 billion rand of jobs protection, 70 billion rand of tax relief, and then also 200 billion rand of guaranteed lending, and over and above that also then, of course, the reduction in the bank regulations.
So, Annabelle, if you can just come in here as well, are we excluding the amounts of money that we are expected to get from other lending institutions, both local and also international, by way of aid to help the fight against the coronavirus and also the revival of the economy here?
Very kindly unpacked is going to be funded by areas. President tax is certain, yeah, 30 billion. It's
Oh, Annabelle, just hold on just a moment. We are just trying to fix your sound so we can hear more clearly what you are saying. But to bring Wendy in also on this conversation, Wendy, before we really get into the nitty-gritties around the restaurant industry, I'd really just like your views on what was shared by the finance minister a little earlier, and of course the president late last night regarding the partial reopening of the economy.
So thank you for that. We're certainly paging through the administrative processes that's been taking place with our restaurants and collectively getting the information which indicates that our restaurants had very little relief. So they certainly have made applications on the various funds, and we're struggling to receive any of those loans or the grants or any of the stimulus that's available in order to bring relief to our industry.
Yeah, and we'll get into the specifics in just a moment. Arthur, coming back to you and just also really getting your broad thoughts on what the finance minister had to say a little earlier, as well as what the president outlined yesterday around this very strategic way that we are taking to start the economy again, but also ensuring that the efforts that we have made in fighting the coronavirus are not washed away.
Yes, so it's a very comprehensive strategy. So it started with the phase one, which was all the initial interventions. That was with the banks themselves. I've mentioned already the loan repayment holidays and also UIF funds that were made available and also measures through the DBSA, the Department of Trade and Industry, Department of Tourism, Small Business Development. That was the first phase, and those measures were quite significant, but they were not very big in scale. It was around about a little bit more than 0.5% of GDP. And then we moved into now what we're in phase two, and phase two is very much, as the minister said, really extraordinary measures. We've mentioned in total 800 billion rands worth of measures. Interestingly enough, as I mentioned, it's not really in addition to fiscal spending, as it were. And I think the government has done particularly well with the reprioritizing and then particularly using all those measures in the financial sector to make sure lending keeps going and where they could through reprioritizing, obviously targeting workers and the poor, but without really increasing the borrowing requirement that much. We know the borrowing requirement is, of course, already very high and onerous because of the large drop in income in the economy that's going to feed through into negative revenue outcomes. But this additional package doesn't put that much additional onus on the government to lend, and it's also indicated that it would look abroad, and I think it could get potentially up to 100 billion rand from, for example, the IMF New Development Bank, the World Bank. So I think they've done very well to fund these very large, or to at least make available all these very large interventions. The problem, of course, is that what we're really talking about here is a big, in inverted commas, permanent loss of income in the economy. And what I mean by that, you for 5 weeks shut the economy down, or a big part of it, so you've shut down most production for almost 10% of the year. Plus, of course, everything's not going to come back on stream very rapidly. It's going to be a very slow process, a very gradual process. Going into phase 4, there'll be a little bit more activity, maybe some additional retail goods being sold, but essentially still an extremely cautious approach, very focused on limiting transmission. So it's going to take a long time for production to come back on board. And in that process, the phase 3 that we would go into would be more broader restructuring of the economy and gearing up for longer-term potential growth. But that is all the structural reform economists are always talking about. That would ensure longer-term growth. But to be clear here, it's this big hole in income that I'm talking about. So what all these measures are doing is it's just trying to facilitate funding, to try and keep credit lines open, to try and keep businesses funded over this very rough patch, and also obviously trying to get workers to stay in their jobs over this period. Because it's very important, obviously, just from a humanitarian perspective, but then also to keep people employed and businesses going, because without these businesses and workers, there's no tax base for a recovery. So all of these measures are about keeping things going. It's not about creating new firms, and it's not about creating new jobs. And so therefore, unfortunately, we are still sitting with quite a big hole in income this year. We're going to take a big smack on the economy, on GDP outcomes, but all of these measures at least do very strongly address the issues at hand, the problems at hand, and I think would help to form a base in going forward from which we can recover, but that would also require structural reforms.
And Arthur, I think that many would agree with you, but of course the President has outlined the fact that we are in stage 2, and stage 3 is expected to see an acceleration of the current happenings in stage 2, but also the things like structural reform and infrastructure spend and a whole host of other measures that are expected to start that revival of the economy. Let's leave it there with you for now, Arthur, and thanks so much for joining us on the show. That was Arthur Camp, who is the chief economist at Sanlam Investments. They're giving a very a balanced review of the latest interventions from the government, in fact, mostly positive, significantly highlighting the fact that we haven't moved to raise our debt too much. So we haven't moved to occupy any more fiscal room that we were struggling to squeeze into beforehand. And about just your view here, coming in on what the President had announced yesterday regarding the partial reopening of the economy in stages to get to the engines up and going again for now, and more importantly, the funding that is going to back that economic revival. Arthur Camp of Sanlam Investments is mostly positive on what government has done so far. It's the best that they could do. He says, what's your view?
I think that I certainly agree with that. It's the best that they could do. And of course, the intervention package is very well targeted. And if we have a look at the different levels, we said at level 5 at the moment, which is very little opening up the economy. And on the 1st of May, the expectation is it will move to level 4, which sees some partial opening up of the economy, but not very substantial. And I think the point really is that we're balancing the weakness in the economy against the stimulus of the financial package, which should still render us seeing, unfortunately, quite a severe recession this year, much more severe than the global financial crisis. But nevertheless, it is pretty much the best, as been said before, that we can really do in these circumstances. The real worry, of course, is what happens if this falls flat. And, some of the real risks to that are obviously we're going to see whether we move from the level 5 we're on now, lockdown, to level 4, and of course moving to level 3, 2, and 1 being, basically virtually full opening up of the economy, but still some travel bans, to see how quickly we move there. And of course, again, balancing lives against livelihoods. So the real concern that we face is how quickly does COVID-19 start to spread, and of course how serious are the cases, what are the fatality rates as we move through the phases of opening up the economy. And of course, if that happens, we'll start to slow it down again. So it's still a lot of unknowns, and I think that's the key point here. A lot is being done, a lot is being put in place, but really it's the best you can do in the face of huge unknowns. What will the reaction really be, from a South African perspective to the infection incidence curve? Not every country is necessarily identical. Of course, it depends on a number of factors, particularly these lockdowns, and we may well find ourselves, moving into opening up the economy, maybe level 3 or 2, and then having to backtrack a bit. They did say it'll be very much determined on economic areas, metropolitans, large metropolitans, provinces, and, still a huge amount of unknowns in the equation.
Mm-hmm. Wendy, to bring you in here, and perhaps you can fill in some of the unknowns pertaining to your industry, and that is restaurants. A big player like Spur saying that it is not reopening anytime soon because doing so would be financial suicide. How many other players in the industry are thinking along the same lines?
We've had a huge response to the Spur letters that have been making its rounds in our industry, and I think it's a responsible approach that Spur has taken. We're not in a position to open up restaurants if we're going to cripple the industry. And whilst we've appealed for the support, we've had very little or no support that has come through in the industry. And it's critical that we talk to this and we open up the dialogue in terms of the funding schemes that have been made available to restaurants as to why we haven't had access to it. So whilst we understand that there is the structures that they've put in place for assessing what is a viable business, having said that, the number of application responses that we've had back indicate that close on 60 to 70% of our industry does not lend itself for viability, which means if we just had to look at that, we wouldn't be in a position to reopen the industry. So twofold we're looking at is one is the formal sit-down restaurants who cannot make the numbers work. We've got a very, very sensitive business model that we need to adhere to. And if we do not get the financial relief, it puts us in a very compromising position. The other part is to look at in terms of the takeaway and delivery area where we may have some potential to open. But again, we've lost 50% of our businesses, and we need to ensure that the 50% balance that is left for us to be able to maximize profitability works within the matrix for us to change our business model. And these are conversations that we need to have with the necessary funds in order to bring relief for our industry. We're sitting with a large percentage of our restaurant staff that are on unpaid layoffs. We've got a large percentage of our restaurant staff that are possibly casuals or waiters who was not registered for the UIF. We're having a lot of administrative challenges with the UIF. We are understanding, we support and acknowledge that the process has been very difficult. It's been complex, but it's now been 5 weeks since the last staff member was paid in our industry. So you can well understand that people are hungry and people are desperate for food and for relief and for support and to understand where we are going forward. And clear communication, I think, certainly eases all this misinformation that is currently happening in the industry.
Wendy, I'll get back to you with the details on exactly the kind of relief that would be helpful for the industry right now. Let's get a perspective on manufacturing and look at that industry and that sector and how it is likely to start getting up and going again. Ayanda Mngadi, who is the chairperson of the Manufacturing Circle, joining us in on this conversation right now. Ayanda, thanks so much for your time. A couple of manufacturers are going to be allowed to reopen come next week when South Africa enters level 4 of the lockdown, May 1st to be exact. Just help us understand exactly which kind of manufacturing can get going again and which kind of manufacturing will unfortunately still have to be locked down.
Thank you for having me. The reality is that I think throughout just the sector as a whole, we have ensured that members are very much aware of the responsibility that falls on their side of the bargain, that as government is figuring out the quickest and the shortest way to get us back on stream, we have a responsibility as well as the sector to ensure that our readiness to re-enter the economy is very much guided by well thought out compliance plans to implement COVID-19 health, safety and hygiene protocols. So just throughout the sector in general, members are ready. Our primary members of the manufacturing circle are ready to go back in all different subsectors. And as well as what we're doing now is we're reaching out to those manufacturers that are not necessarily our members, but who are operating throughout the country. Some of them are belonging to chambers of commerces within cities. And we are encouraging these members to work through the same survey that we use for our members to look through compliance areas that can allow them to be sure, because I think there's a point that you made earlier that it would be, the saddest thing would be to take a step forward and then take a step back because we have not prepared enough. It's one thing to put pressure on government to allow us to operate, but then if we are not ready to be responsive to those things that are on our end of the bargain, it will be catastrophic. The difficulty of trying to delineate between the different subsectors of manufacturing is that sometimes you find that a lot of them are part of each other's value chain. So I was looking at what is currently circulating, which is showcasing, for example, automotive as part of stage 3, and then I think later the rest of manufacturing, including construction, being part of stage 2. You're finding that some of the members would be, like, I think steel and cement is part of stage 3 as well, which means they'll come on board quite early. The difficulty with that is that you find that some of your enablers, including your client base, is sitting in another category. And that is why it is a true challenge to actually separate manufacturing and say, these people can start first and these ones cannot. And so it's going to be critical for us to be able to gain a level of granularity and an understanding between us and government. And that's why we're making sure that everyone is ready to go back, so that that delineation is not necessitated, because otherwise you will suffer. and a producer will be on board, but their customer will not be. And so we're running this media campaign at the moment. We have a survey that's currently on our website, and we are inviting all manufacturers. We've spoken to sister associations to make sure that regardless of which subsector you come from, please make yourself ready. Make sure that you have clear regimes around testing. Make sure that you have clear regimes around hygiene and keeping the place safe, and moving even those members of your staff that are depending on public transport, for example.
No, certainly. And another thing that did come out of today's briefing, of course, was the comment around the land bank and the finance minister expressing his concerns around the state of that bank following the confirmation from the bank earlier this morning that it had defaulted on some debt. Let's take a look at what the minister had to say with regards to the land bank. All right, as we continue to await for that clip from Finance Minister Tito Mboweni on the land bank, we are seeing that we are closed, and we'll bring you those numbers in just a moment. But perhaps we do have that clip up right now. The land bank, this is what the Finance Minister had to say.
The question around the land bank, it's a very important question. The land bank has come under severe stress, and the National Treasury, particularly the Asset and Liability Management Division, the land bank, some of the key banks which the land bank has got credit facilities with, and myself have been engaged in lengthy consultations to ensure that the land bank is able to continue functioning. Those conversations and negotiations are going on, but one thing is for certain: the World Bank has difficulties, is in trouble, and our responsibility is to do whatever we can again to support the land bank.
Annabelle, what's your view on the land bank and the default today that has transpired? And also, is this a signal of more trouble for state-owned enterprises? What's your feeling around this?
Look, I think certainly it does raise some concerns. I mean, defaults obviously do that. And of course, some concerns about the risk of government debt defaults on a wider perspective, particularly due to the anticipated higher debt servicing costs, interest payments, because obviously of the increased pressure on government expenditure. And let's not forget the fact that GDP growth has deteriorated substantially, and that not just impacts revenue from a government tax perspective over the broader economy, but obviously it would also impact the agricultural sector as well. And the real concerns are, it tends to heighten risk aversion. So the reality of the situation is we're in a heightened global risk averse environment because of COVID-19, because of the impact, the severe impact that it's having on economies. And of course, globally, we are seeing substantial contraction in a number of economies. Now, the global recession is expected to be very deep, very severe, U-shaped. That's a slow recovery, and of course, much worse than we experienced in 2008, 2009. Similar is obviously likely for South Africa. And of course, when you see heightened risk aversion, you do tend to see some sell off, whether it's of inflects in the weaker currency, and of course as well concerns around investors, whether it's the size of the stimulus package, the pressures that may come to bear on government finances, and of course the ease of repaying debt, that then also tends to reflect in higher bond yields that can push up your bond yields. But mostly, I suppose, some of the real worries certainly are as well from a government debt perspective, our credit rating. So, we're not forecasting any type of government debt default. We don't think that's going to happen. But we've seen other institutions run into trouble, financial trouble. If you look at Eskom, other parastatals, SA in particular, they get a lot of government support. And I think, Tito Mboweni, quite clearly saying they'd be looking to give support here to the land bank as well.
Staying with this topic of supports, and Wendy, just to bring you in here for a better understanding of what kind of supports or relief would help the restaurant industry. And this question coming off the back of the fact that the government has announced various maneuverings around tax, companies paying lower tax, companies deferring certain payments. There has been room made in terms of pension contributions that companies make right now, just to make sure that companies have enough, money in their pockets to withstand these really difficult times. What are you saying that some of these interventions, particularly for companies, have not been enough or will not be enough for the restaurant industry, particularly when it does get up and going again?
Absolutely. So I think that the overheads don't match the capacity for us to reopen down on formal seating. And the expenses on a particular restaurant are far too high for us to be able to afford the financial models that are sitting with us at this space. And the appeal that we made for everybody to play a role in reducing the fees hasn't come into effect, and that's why we are struggling. Also, the financial relief that's been offered doesn't match the financial model that restaurants operate under, and we need to open up these dialogues with the necessary banks and the necessary funding houses for them to better understand how restaurants are geared in order to make that lending available to us. So we can't possibly be in a position where almost 60% of our industry is almost in liquidation. That just wouldn't work. I mean, our restaurant industry is a thriving industry. We've certainly made a huge contribution to the GDP. We one of the highest employers in the industry. And we need our restaurant industry to be saved by government. They need to look at bringing interventions in place that will certainly save the industry. We can't just rely on restaurants not being able to open. The cost to reopen a restaurant going forward in the lockdown and post-lockdown it's a huge amount of money per restaurant. And we can't afford to be closed down or have another hard lockdown because it will cripple the industry. We need working capital. We need to be able to purchase goods on the supply chain and to be able to re-engage with the supply chain. And as you well know, the sensitivity model of a restaurant really leads itself to a 90-day payment plan on most of our suppliers. So these are all the factors that we need to look in. We look at the takeaway market. We're eager to wait whether there's a time frame that's going to be given to us and whether the green light will be given a go in terms of relighting the gas burners. We believe that the consumer is eager to get takeouts up and running, but we need to make the financial models work. And the financial models can't work if we don't get support. We're looking at third-party restaurant delivery services wanting to come in between 27 and 30%. So it means that a restaurant that is already going to be taking a cut of 50% because they have no seating capacity and expected to try and pay 100% of their monthly expenses on a 50% turnover, which could no guarantee of what the turnover could be at a 60% rate. We could definitely sink the industry if the landlords don't come to the party, if utilities don't come to the party. And we need to understand, what is the proposal that government has got to help relieve the restaurants that haven't had relief, as well as the staff that haven't had relief from the UIF.
Right. Just finally, Ayanda, if you are still there, we're talking about the future of manufacturing and lessons that can be learned from this crisis. A lot of companies are talking about the increase of localization strategies right now because as companies or as even we as a country start to partially reopen, there are some areas whereby we still have supply chain disruptions that could be a problem for the companies that get a lot of their stuff offshore. What opportunities are you seeing for the manufacturing industry to pocket from COVID-19? And specifically, if you can speak to the opportunity perhaps to increase local manufacturing.
Obviously, the biggest challenge that has been exposed by the pandemic is our extreme dependence on the imports and extreme dependence of our businesses, particularly big businesses, on gaining our capital from exporting. It is something that we obviously need to prioritize as individual manufacturers to ensure that local manufacturing takes a bigger chunk of the production that we currently produce. The difficulty, though, is that with some of the producers, there is not enough capacity for consumption locally in the country. And as a result, you end up forced to actually export some of your product. And you actually, even though you can supply and satisfy almost 100% of what is local demand, but you still struggle because the full operation of your plant still requires some level of export. And so I really believe that it's going to be a serious balancing act going forward. It's about also not only looking at our own country, but looking at the balance of the continent and trying to explore possibilities of looking at growth that is pan-African more than anything, and looks at economies that are within the continent where it could be easier for us to grow into those greenfields. The bigger challenge as well is the growing protectionism around the world. And that is actually causing some of, because even under these circumstances, you're finding that there's quite a lot of pressure for manufacturers to try and survive in those foreign destinations and continue to make a living. Whilst we welcome, I noticed that under level 4, the export markets will get a relief, or those who of our manufacturers will get a relief of being able to actually export. But the reality is, if you cast your eye forward to another 5-10 years from now, I think we'll be sitting around the table trying to figure out where are the new markets instead of us looking at the foreign markets that we are dependent upon. Another addition is that our ability to create jobs. We're currently sitting at just above 1.7 million jobs, and retaining those people gainfully employed is very much dependent on our ability to bolster our local economy. And so COVID-19 presents us with quite a number of opportunities to really dig deep, and I think all countries are facing the same challenge, to really dig deep and just really localize and take...
Certainly. Ayanda, I am sorry, I'm going to have to interject there. We are out of time. Thank you so much for your insights there. Of course, Ayanda Mgadi, chairperson of the Manufacturing Circle, alongside Annabelle Bishop, chief economist at Investec, and also Wendy Alberts from the Restaurants Association of South Africa there.